Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, it's the man himself, the governor of the great state of Texas in real estate, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. How you doing?
Oh, man, I am a little sore today.
Yeah, what happened last night?
Well, we raised $23,000 for homelessness for children that are in a predicament with homelessness up in the Plano area. We put $23,000 into a homeless shelter that really focuses on children. So we had a bunch of the real estate community of North Dallas area come out and support us. And we were throwing the ball left and right. And what a lot of fun with that. So we were bowling for the homelessness problem that we see out there. And boy, am I sore today.
Yeah, a little bit than last year when you broke your wrist playing basketball when you
this year,
3-on-3.
That's right. This year, nothing was broken except for my spirit, because if you've seen me throw the ball, I was very lucky that I was so accurate that I was only hitting one pin at a time. It was right on the edge. And it was 5 times in a row. It was just one pin, all on the right-hand side, never went into the center, never knocked anything down. And then, by the way, I got fired by the team, so they had to replace me with somebody else for round 2. And so what we've learned is I'm not a good bowler. But who is a good bowler is Ricardo Hinanoso with Old Capital, who's joining us today, too. Hey, Ricardo.
How's it going? I don't know about a good bowler. The Old Capital team, we started off okay, but we fizzled off pretty quickly in the end. I think we got fatigued, but it was a lot of fun.
Yeah, congratulations to our friends over at GREA who took home the big trophy last night, and the homeless shelter took in $23,000. So we certainly do appreciate everybody who came out to that event. We certainly were amazed at the competitiveness out there too. So today we're going to talk a little bit about the state of the market. So we brought Ricardo in from Old Capital to talk about things. We brought, of course, Michael Becker from SPI to kind of just talk about the state of the market. It's a little bit of a potpourri, a little bit about everything that's going on. And one of the things that popped up that I saw this morning was a 4-property portfolio out of Houston that went into foreclosure, Michael. I mean, not to give away any of the names of the guilty, but what do you think about what's going on these days?
Well, I mean, I feel like you and I were kind of the boys that cry wolf a few years ago, thinking that didn't make any sense. I remember we were chatting last night, Paul, and I remember telling you, I distinctly remember Paul saying these debt fund bridge loans are for the sellers, not for the buyers, or something to that effect. You said that a few years ago, and it's what I think kind of basically happened here. I mean, the guy was inexperienced not that long ago. He decided to go take a 80% bridge loan, maybe put some prep behind it, get 85, 90 levered on a bunch of really tough properties in Houston, and this is the rates rose on them and couldn't do a cash call, couldn't keep the operations up. Had a bunch of other issues, I'm sure, with taxes and insurance. Houston's a mess right now, and delinquency, et cetera. And then, unfortunately for the sponsor, and more unfortunately for all the investors that put money in the deal, they just got foreclosed upon. So I think that's probably the first one. I think other people, kind of had similar capital structures, especially, Houston's gonna see the pain a little bit more first in Texas, and then, maybe it'll bleed up north a little bit to some people that have similar structures. So yeah, it's real unfortunate, but it's not like overly shocking to me, because I mean, I think we kind of saw this coming. I mean, it's high risky structure, paying big numbers with inexperienced people. I mean, I guess this is what kind of happens, right?
Absolutely. I mean, unfortunately, this whole group of investors has lost all their money into this deal. So
I'm curious to see too, what I'm thinking of is he did a bonus depreciation. Everyone wrote off 200% of their investment and depreciation. Now they're going to lose all their money to pay taxes when they recapture it too.
Now
that's the next shoe to drop.
Yeah, so go into a little bit more detail on that, because a lot of people don't understand that when you give this property back and you've taken the bonus depreciation, with the IRS and on your personal tax returns. Mike, I know you're not a CPA or a tax person, but what's your understanding?
Yeah, that's yeah. Again, not qualified, but I wonder if a lot of these guys marketed 200% bonus depreciation because they got such high leverage, put some prep behind it. They allocate all the depreciation to the common equity, and then so you put $100,000 in, get $200,000 loss, and then you lose your $100,000. There's debt, goes away. Then you got to shut the entity down, and then you got to recapture that extra 100,000 that you wrote off. Because you doubled your depreciation. So it might be if you're in a deal like that, you might want to not go spend all your money because you might have 25-30% tax bill coming on the 100,000 and additional depreciation you took.
Yeah, if you are in a position like that, make sure you talk with your CPA fairly quickly and just get their opinion about what that could lead to for the future for your own personal income taxes. One of the things that Ricardo does, I think he does an excellent job, is trying to advise people before that happens about, just really being protected out there. So Ricardo, what, again, Old Capital is a value-added multifamily lender, and so we're just not a transactional lender. But tell us some of the things, Ricardo, that you do on behalf of sponsors and limited partners, just like to talk through where we're at right now, where we're going to go, and so give people kind of just a general understanding about what you do.
Yeah, no, this is a hot topic, and this is something that we're spending a ton of time on right now. Just that. So any borrower that has a bridge loan, any borrower, a client of ours that has a bridge loan, or others are reaching out. We're spending a ton of time every month underwriting deals, trying to figure out at what point can we exit. So that's kind of the rallying cry right now is let's figure out a way with the way rates have gone up. It's obviously a lot tougher now, but if you're in a high leverage bridge loan, you should be scrubbing your numbers monthly, connecting with folks like us to try to figure out where you are or where you need to be. And one of the interesting things that had just come up over the past couple of weeks, Paul, is the impact on taxes, right? So we'll have a lot of I'll have sponsors reach out and say, hey, I think I'm ready to go. I think my NOI is close to that 125, given, let's say you assume rates are 5.5. I'm at the 125 mark, but then we underwrite the deal. And a thing that sponsors are missing is that even though it's a refinance, your tax number is going to go up from an underwriting standpoint. So the appraiser, when we appraise a deal, is going to say, hey, the value is moving up, and Fannie or Freddie and the appraiser are usually going to underwrite, let's say in DFW, 75-80% of that new valuation. So you've got to make sure that you're going through the right underwriting and you're making those assumptions, because you may think you're at a 125, but once you adjust your taxes, we're finding that a lot of people aren't yet. And then we're in a little bit of a sweet spot right now where you've got GPs that are going through a protest or have gone through litigation and have recently settled, right? So if you settled, great. We've got a lower number. Let's go, because at the end of April, your 2023 assessment is coming out. So as soon as that comes out, we're going to be forced to use that number or higher on the refinance. So just some nuances. I think that there's just a little flavor of kind of what we're doing, but every month we're working diligently with these GPs, trying to figure out, how do we get out of these deals?
Yeah, some of these deals are bear traps that sometimes you cannot get out. And the person that had those 4 properties down in Houston got foreclosed upon, and those were big numbers and 4 large big properties that I don't think that he had interest rate caps on that deal, which means that he didn't have protection or insurance to cover in case the interest rates did rise over the period of last 12 or 13 or 14 months. So when he took those deals out, rates were low, and now they've gone up by 5% without having that insurance. That's a huge number that you have to come up with every month. And if your properties are not doing that well in terms of collection of rents and bad management, you're not putting more money because you don't have it into the repairs and maintenance of the property. It just becomes that downward spiral. And so that's very tough. And so this is the best time to build those relationships with your teammates, if you're a limited partner, and just listen to a little bit about what's going on and have, what we're doing is every month is we're talking to general partners out there and just giving them a sense about where they stand right now. Because if you didn't have an interest rate cap, interest rates on some of these bridge loans are up to 9% or even higher. But somebody that is doing very well when they're looking to refinance, and you didn't have one of those high interest rate bridge loans, but you did refinance a property, and then you also buying properties. Tell us about just a current success, Mike, that you had with interest rates and in buying properties. Again, not everybody's like Michael Becker, so we can use that as an example of what it is. But Michael, give a shout out to what a success was for this week for you.
Yeah, we've refinanced a few deals that close this upcoming week, and those are both going into a life insurance company. Kind of mentioned previously, I think, on the podcast. We're doing one is 5-year, 1 7-year. We have 2-year lockouts on them, and then we have some flexible prepayments thereafter. So we took a couple bridge loans we had, and we're able to refinance those, or those are closing this upcoming week. And then we had sold a property in December, and we're buying a deal down in the Austin area on a 1031 upleg. And we were very successful this week. We were able to rate lock. So there's been quite a roller coaster on this deal, Paul. We got awarded the deal right before NMHC, which feels, it's only 2+ months or so in the past as we record it, but then it feels like, 2-3 years and the timeline of the interest rate volatility where rates were low, we agreed to it, they spiked, and then, kind of bounced around. And then the banking mess of about a month or so ago, just rates dropped, and then it went back up, and now they're back down. So anyways, we timed a recent dip in the market in a position, and we ended up doing a 5-year fixed rate deal, full term IO. We ended up getting a 4.75% fixed rate with a Fannie Mae loan. So that was
what leverage point was that?
Yeah. So the two key things about it. So we were 65 levered, or three key things. So we're 65 levered. So this is not the higher leverage bucket, but that's kind of about where these deals get debt service constrained anyway. So it's probably the reality for most people in the marketplace. So that's one factor. Two, we're getting select sponsor pricing since we for borrower the agencies we've done hundreds and hundreds of millions with each of them. So we'll get a little better pricing than Joe Bag of Donuts, as you would call them, Paul, off the street. So we get a little better pricing there. And then finally, we ended up buying the rate down with a point. So we paid a fee up front, and that got us around a 1/4 point buy down on a 5-year deal. So it would have been a roughly 5% fixed rate if we didn't buy it down. We bought it down to about 475 or 475 at full term IO. We got a few waivers also being deferred borrower and repeat borrower that successfully paid off stuff in the past. So those are some things to keep in mind. It's not always apples to apples. The other key thing too is this deal had a lot of affordability, the way the agencies model it. So they call it kind of quote unquote mission rich. So they have quite a bit of that.
All right. Fantastic effort to try to get that lower rate. Good for you. So
one thing to kind of add there, Paul, with the drop in rates that we've seen over the last couple of weeks, we've been able to pull the trigger on a number of refinances. So one thing, as we're working with you, one of the strategies that we've been using on these refis is to go ahead and get things ready to go. So go ahead and get the third parties done. Third parties are good for about 6 months. So we can get you teed up. And the market's so volatile right now that it's tough to time. If, hey, rates have dropped this week, you tell us, hey, let's go on the refinance. Well, you're probably 2-3 weeks away from being able to lock, right? Because we've got to underwrite the deal. We've got to, get you an application, get the third parties done. Well, if we have everything teed up, the third parties are done, and then we go once you're ready. Once the market poses a good opportunity. So we're doing a lot of that right now. Kind of switching gears a little bit, Paul. I'm getting a lot of questions from an underwriting standpoint, especially from newer borrowers, and we wanted to bring this topic up. But we get asked a lot: what does a mortgage broker get paid? How do we get paid in the transaction? Can you kind of walk people through that?
Yeah, that's a great and timely question that a lot of people have had, because they always think that the lender charges 1% or 2%, and then you guys who are the brokers charge 1% or 2%. All of a sudden, you look around, and that's a lot of money on these deals. And so that's really the point of the conversation, is that's not really how it works. And I'll just use Fannie Mae as an example. I don't know how many people own homes out there that have mortgages. Probably a lot of people have mortgages on their houses. And so how did you come to get your mortgage on your house? Did you come through, I don't know, let's just make it up. Did you come through Wells Fargo directly? Did you go to Bank of America directly? Did you walk into the branch? Did you meet Mr. Jones or Mrs. Smith, who's the loan officer for Bank of America? Did you sit down with them in the office and they took an application on you? And I would say probably 65 to 70% say, no, I went to go talk with the mortgage broker that was a referral to me that I heard had done a real good job to get my home mortgage. And so that's a little bit about the differences. It's kind of the same thing that happens on the residential side as it is on the multifamily commercial side, is that there's two different ways that people come to get that same product. So if you walked into the branch that's called retail banking, that you got yourself a mortgage, then you talk with that loan officer, or you come through a mortgage broker who kind of has the wholesale price from that same bank, so to speak. It just has a different door comes onto it. So the pricing has to equate out directly to the consumer. So where Bank of America is going to charge 1% if you were to walk in, because they have to pay for that loan officer and that desk space and that all those benefits and a commission to them and a salary and all those things, is that they found a long time ago that it was almost better to have a wholesale channel where they don't have to continue to pay people on a salary or pay those benefits, is that they'll let the brokers do it and get paid just a piece of the deal. So the pricing is pretty much the same at the end. So we get it at a little bit of a discount and we add that fee into the deal where the retail person gets the full pop cost and that's how they push it over to you. And so there is, when you come to see it, it is probably pretty much the same price. And that's the same thing when it comes to multifamily, is that when you go to Fannie Mae, when you go one of the lenders and you come to us, our pricing is pretty much going to be the same as the retail side of every group. And so you're not going to pay twice. And so what we do typically is we kind of split that fee with the lender. And so they've already priced that into the transaction. And so what you see is pretty much the same price that everybody's going to pay if they went direct, because it's cheaper for the DUS lender to have us go be part of the solution, that they don't have to pay us continuous salary and pay us bonuses. They just pay us for the piecemeal of the deal when we bring in and we successfully close the deal. So that's a great question to have. And I want to make sure we have clarity onto it. So if you're getting charged a point by a lender and we're charging 1%, it's the same deal. You're only going to get charged 1%, whether it comes through the wholesale channel or the retail channel. You as the borrower are only going to see the 1% fee, typically, as we say on a Fannie Mae transaction as an example. Any other questions on that one, Ricardo?
No, that pretty much covers it. I think that's where we feel like we come in and try to add as much value as possible. And that's why folks will reach out to you and to James and to the team, because you're not paying anything extra, but you're getting the value that comes with working with that broker.
I always say we're the Cheesecake Factory menu of different loan options. So I think that is one way to take a look at it. So if you only if you went to Bank of America, and when I worked for the large banks, I only had one product, and someone needed something that I didn't have, I had to send them down the road. Now, what I do today is I have the full menu of different things that people can take advantage of using my knowledge and structure and using the team's knowledge and structure at Old Capital, put these deals together. So I think that's a good point, and we'll stop it right there in terms of things. Mike, what else are you seeing out in the market these days?
Limited inventory, right? I think we're still seeing not that many properties for sale. There's been a few more here, but it's I don't know, like maybe 25% of normal listings right now, maybe less. And I think maybe workforce housing, it's the class A or A minus. It seems like maybe workforce housing has 10 or 15% of the normal listing volume right now. I don't know if you two have a sense of that, but that's kind of my anecdotal gut here.
Yeah, I saw a rag that talked about that the volume of business is down 75 to 80% from what it was a year ago. And that certainly feels that way. Ricardo, what do you think?
Absolutely. I think less deals in the market. Every deal is taking a little bit more of an extra effort to try to figure out solutions. I think over the past couple of months, a lot of our role has been, figuring out how to get deals done, finding solutions, but they're definitely, the inventory is down. Mike, one of the questions that I've been getting, and I wanted to bring up that I'm getting a lot is, with the volatility in the capital markets, from a buyer perspective, how much cushion, from an underwriting standpoint, if you're looking at a deal right now and I send you a quote and it, 65% leverage with a, 5% fixed rate, How are you going to underwrite the deal? How much, given the volatility, are you adding a little bit of a cushion in your underwriting right now?
Yeah, I think so. I mean, I think you got to add, 25 basis points, maybe a little more to whatever we're quoted in the model. And then, so I think you guys were talking about a few minutes ago about when you're getting ready for a refinance, just kind of like getting prepared way ahead of time, tracking it. And when the market gives you an opportunity, you're in a position to strike and take advantage of it. So I think that's really kind of what we're doing. Maybe that's a kind of a greater takeaway. I think it's more important in a market like we're in today, where everything's, moving 10 or 15 basis points, every freaking day. And, normally that's a huge move. And here it's like a daily occurrence. And then, you think you're going to go to the moon, and then it reverses and the rates come down. And then we think it's going to keep going, they reverse back up. So just kind of really, really challenging. So seems like we might be kind of settling in a little bit of a band, but the band's pretty wide. So, can swing 50 basis points on you in a week real easily. So that can, make or break cash flow. And then that also has ramifications on the sizing of the loan and the proceeds you're going to get. So, it's just very volatile. So I guess what we're doing is, say, hey, we get awarded a deal, or we think we're going to win a deal, because, been doing this a while. So you got to get a pretty good sense when you're close on a deal, and which for the profile sets up well for you to win it. We're getting in, getting not only a soft quote, but we're saying, well, let's get submitted into Fannie and Freddie both if we're going to do this deal. So if you can, I don't know if you guys want to be doing that for everybody, but if you guys are really close, you feel like you have a high level of confidence in winning the deal, a lot of the Fannie and Freddie, lenders will, submit into them and ask for these waivers or that waivers and get a formal quote out. And then by the time, you awarded the deal, you move to get the contract, you basically have an application that you can sign, simultaneous to signing the actual purchase sale agreement or the purchase contract. So, we know exactly what the terms of the loan are going to be. And then it's just really the rate can fluctuate up and down. So, we're just taking the mindset that we're being proactive. We're getting ahead of these things. We're, getting all the formal quotes out, getting applications where we can execute simultaneous to signing a contract. And if the interest rates work for the business plan that we want to do, we just go ahead and lock. And let's just take the risk out. If they don't work, then maybe we monitor and hope it comes our direction or this or that. But, the moment the market gives us an opportunity to lock a rate at a workable number, we're just going to take the risk off and then not look backwards at maybe if I would have waited a week, I could have saved another 25 basis points or whatever. If it works, you just take the risk out. So I don't know if that answers your question or not, but that's kind of what we're just being extremely proactive and upfront. And then, where maybe 2-3 years ago, you didn't have to worry about that as much because the market didn't move and we knew what the loans were going to be. And it didn't really matter if you locked today or locked in a week, it wouldn't be appreciably different.
Yeah, no, that's fantastic. I think that the whole concept of compressing time is as important as it's ever been. Is to just get things out of the way and get decisions made. The whole rate lock thing is another nuance because for strong experienced sponsors like yourself, once you rate lock, you're going hard with more money essentially, right? Because on these conventional
2%.
deals, it's a 2% rate lock deposit. Now you get it back at closing, but you better be damn sure
Provided
you
you
can
close.
Yes, provided that you close. If you don't close, then that's more money.
And there's a timeline too to it. So, you got to deliver the loan by X date. And if you miss that date, there's usually about a 3/8 fee. So then that's an actual fee. So that's an expense if you mess it up. So you gotta think, okay, what's my timeline? If I got to raise money, can I get it done this time? And blah, blah, blah. So there's a lot of competing factors you gotta weigh when you're making that decision. And then, the pricing changes. If you have an extended rate lock versus a shorter rate lock, the pricing goes out because it's volatile in the market. So, not to get too deep in the weeds, but there's just a lot of things. I think the moral of the story is being more proactive than ever is really what you need to be. And then just get yourself in a position to be ready. If the market gives you a workable number or whatever, we're just striking right away. And that's how we've kind of navigated it. We had 6 deals or so we need to get refinanced this year. We got 4 of them done and got 2 of them I'm hoping to get kind of signed up next week. And then, and we're going to be done. And then back's clear and we're going to go be, offensive.
Yeah, you can go back to sleeping at night instead of screaming and grinding your teeth as you were thinking about all these loans that were on adjustable rates. So.
Yeah, and I think the thing is what I'm finding, Paul, that we're in a better position. And just kind of thinking about this as if you try to mature in your career, because this is a moment in time. I mean, this is, the sky's not falling. This isn't 2008, I don't think, but there's going to be some pockets of pain, and the pockets of pain are, unfortunately, like that story we talked about at the beginning of this recording, which is, Houston, terrible workforce housing, over levered, inexperienced sponsors, didn't buy insurance on rates, had a short-term maturity, had no liquidity to backstop it. It's kind of like a perfect storm of what not to do. It's kind of all put together, and a bunch of unsophisticated people giving that guy money, obviously, because the smart people were like, what the hell? Why would I give that guy a bunch of money? Because his structure is fundamentally flawed. And, you see that a mile away if you've been around the block a time or two. But I think there's going to be some, little pockets of pain focused in that specific subset of deals. But what I am finding is we sold the old stuff over the last few years. I sold it too early. We bought our C-class deals at 8+ caps, raised the revenue a ton, sold them when the caps went to 6, didn't know they're going to 4, but, made a bunch of money. Then we traded up in quality. And so that now I'm looking at some of the deals we have. We didn't put 85% debt funds on it. We were, 65, 70 levered on most of these deals on acquisition. And so we weren't over levered. And then now we, have high quality deals and better markets. We're not in Houston. We're in Dallas, Austin, San Antonio. So the lenders, I have options, right? So I got Fannie, I got Freddie, I got Lifeco. And to the extent there's still some, bridge debt out there, that if I want that, that's out there as well. And so these Lifecos and Fannie and Freddie, there's very little sales volume going on right now. So they have, what was it, like 85 billion each. The agency's got to get out. And Lifecos have all these loans they got to go make because they didn't make a lot of loans last year. And they're all chasing, they can't do office, right? That's a no-go. Retail's tough, and there's only so much industrial out there. So it's just really kind of gravitating to multifamily, and they want high quality, better the market, newer product. That's what they want. And so we got kind of, we're the belle of the ball right now. It's weird. Like we almost have more lenders chasing us on these couple of refinances just because we fit the subset of what they want. And they're not going to go chase the 60s deal with a chiller in South Dallas. They're going to chase a nice core deal that's 3, 4, 5 years old. So it's kind of interesting to see that play out. There's actually a lot of demand from the lenders, but it's just so specific in what they want. And we just happen to have positioned ourselves to be in that position. And it was intentional. So I think if you're trying to be sustainable in this business, as you're getting older and maturing, selling the old stuff, buying bigger, better, prettier things. I mean, that's just kind of a natural transition. And I think we're seeing the benefits of that, as well as cap rates are generally expanding right now. Like I mentioned, I don't know how many times I said it on this podcast, Paul, that, it didn't make any sense for the cap rates to be the same or similar for something built in 1974 to something that's brand new. As cap rates are expanding, the Class A's are expanding at a much slower rate. They're much stickier on the downside. And if you have a chiller deal and a sick flat roof chiller deal with a boiler and a questionable submarket, I mean, those are definitely north of 6. They're probably north of 7 to be realistic to actually clear the market right now. And you bought it at a 4.5 cap. I don't know how much you raise your rents, but it's not going to be enough to offset that expansion.
Yeah, everybody talks about raising rents, but that cap rate, again, is another bear trap that when it expands so much, there's no way you can raise rents high enough to justify it.
Yeah. So there's got to be a spread in the property grades, right? There's risk in the workforce housing, especially on the subset of the lower end quality stuff relative to the nicer stuff. So there's got to be a spread. And that the market is putting the spread back in right now, where the market was defying gravity for, 3 years, 4 years, in my opinion. So that's what's playing out. But anyways, those rambling thoughts. So just kind of what we're seeing, trying to navigate the debt markets right now.
So Ricardo, what are you seeing, for the new buyers coming into the deal? If there is any, what are you seeing for the new limited partners? What should they be doing during this gap, the time from the period that people are really not transacting to in the future where they will be transacting? So, what should both sides, the general partners and limited partners, what should they be doing right now?
Well, if you're a general partner, if you have a deal, a lot of what we've been talking about, being proactive, making sure you and your passives are safe, giving them reassurance on deals. I was just on a webinar this past week with a general partner who's done a couple of deals, but he's got a bridge loan. His passives were a little concerned. So we all got in a call, walked his limited partners through everything that GP is doing. He had us come on to kind of talk through our perspective of the deal. So I think if you're in that situation, just making sure that you're being proactive and you're communicating extensively with your limited partners. If you're new to the business, so I think right now is a great time to get educated, to start underwriting deals. There aren't a lot of deals out in the market, but right now is the time to get in, build relationships, get some experience in doing this over and over again from an underwriting standpoint. So when the deals are there, that you're ready. I think this is as good a time as you can get to, from an education standpoint, just understanding why those that are in trouble, learning from that, and then just being ready for the inventory when it comes.
And it's coming. Is it coming, Mike?
Yeah, I think so. I think there's definitely going to be some opportunities and opportunity out there, and so we'll see how deep it goes as the rates kind of roll over. That'll mute some of the pain, but the banks and debt funds and CMBS. I mean, I don't think there's any CMBS deals going on right now too, so that's not that prevalent in our side of the world and the multifamily side. But they try to go get an office loan right now, I think is next to impossible. So there'll be some opportunity, but we're if you're like us here in Texas doing business in Texas or the Sun Belt and the better markets, there'll be winning markets and losing markets, and I think we'll be in much better shape. And again, it's a moment in time. I don't think this is 08. 08 was everything was terrible. This, I think, is a subset within the multifamily industry, right? I mean, office and some of these other asset classes will have some problems, and they're not going to say that can be some knock-on effects, but the 08 was absolutely terrible, and the banks were in much better shape than what they were back then. So it's a moment in time, and just be ready. And
you were the crypt keeper in 08, 09 for your bank. What does that mean? What did you do at that period of time?
I learned about problem loan workout and how to go collect money. So it was I was about 30 years old, in my early 30s, and it was a great learning experience to go through, because it was everything was up until it wasn't, and then you had to go collect it, and all these things that were obvious with a little bit of hindsight, or it was obvious to all the guys that were in the 50s and 60s when I was in my late 20s making these loans. They're talking about the 80s and the S&L and thinking us dumb young bankers were stupid. It probably exactly what you and I and Paul were talking about. All these guys putting, debt fund, high levered debt fund with pref behind it on hood properties at 4 caps. We're thinking about the last 3-4 years, so I don't know. And we were the boys that cried wolf for 3-4 years. And you go listen how I thought I was wrong forever and ever. And then maybe we're right. I'm not trying to gloat or dance on anyone's pain or anything, but I think that the point is the market's going to grow out of it, and as long as you have enough staying power, those deals are going to be fine too. You just got to get on the backside of it. So if you have a Fannie Mae fixed rate mortgage, or even a Fannie Mae floating rate mortgage or something like that you got 3, 4, 5 years of term on it, you're probably going to be fine. You're just going to be tighten the belt for a few years, and the backside of this is going to be just fine. If you are forced to pay a big amount that you can't cash call on for the next 12 months, so those are guys that are going to have some problems.
Ricardo, are the banks out there? We talked about Fannie Mae, Freddie Mac. We talked about CMBS. Some of the people are open for business, but ever since the Silicon Valley Bank and Signature Bank and Silvergate and all these other regional, large community banks and regional banks, that they've started to pull back. What are you seeing personally about when you're talking to some of these folks? Are the 20, 25 million, $30 million loans out there? Is there money to refinance into a regional bank type of a transaction?
The banks have definitely pulled back. We're not seeing a lot of activity. They're just not competitive. Those that are out, their pricing is significantly higher than the agencies. So where last year, Q3 and a little bit in Q4, we did quite a bit of bank business. If you go back and look at kind of our mix last year towards, that second half of last year, we were doing quite a bit, especially deals below 10 million. The banks were very active, but that's totally reversed now. Anything, in that range is going Fannie or Freddie SBL. So as long as you can qualify for agency, then we're going agency. Even if it's low leverage, the agencies are really delivering right now, and the community banks are just not competitive, or they're just not in the game.
Yeah, I mean, and remember, Fannie and Freddie are not value added. They're not a bridge lender. They are stabilized, cash flowing today, yesterday, 6 months ago. What is the cash flow currently on the property? Not to where it's going to in the future, but what is it today? So remember, Bridge loans are like looking through the front of your car window of where your car is going in the future. Fannie Mae and Freddie Mac loans are where it's gone and where it is at today. So don't forget, on April 26th, we have another speaker series coming up at the Grapevine Convention Center. So we're talking about, operational efficiency through management companies. So we'll have 250, 300 people at this meeting again. And what we like about this meeting, talking about property management, is we'll divide it up into 3 different sections. And if we just talked about property management, your eyes will go glazed over after 15 minutes listening to somebody talk about how to manage properties. But we're going to have an interaction meeting. So we'll break it down to 3 different groups to try to assemble as many good responses to some of the questions that we will provide. And I think you'll like the interaction, how we'll put that together. So come see us on April 26th, Grapevine Convention Center here in North Dallas, up in next to the DFW Airport, again at the Grapevine Convention Center. Make sure you RSVP to oldcapitalpodcast.com, Old Capital Podcast, or oldcapitallending.com. RSVP to that event before we run out of seats. So we certainly do appreciate Ricardo Hinojosa pitch in today. Thanks for coming in, Ricardo, giving us your perspective about what's going on. Mr. Michael Becker, the governor, good to see you again. Very much appreciate coming into your podcast.
Thank you, Paul.
Again, on behalf of Ricardo and Michael Becker, I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.